Welcome back. In this lecture I'm going to show you how the balance sheet works. Usually in the balance sheet we have two main sections, the asset section and the liability and equity section. Now the asset section is comprised of current assets and non-current assets. The current assets are all those assets or items that have a life of 1 year or one accounting cycle. And the non-current assets are all those assets that have a life longer than 1 year or one accounting cycle. If you look at our current assets here, you can see that we have 4 items. We have cash, AR, inventories, and prepaid expenses. Why do we see them, or do we see those items in this way shown under the current assets? Well, the main reason is because usually the current assets are listed from the most liquid to the least liquid. Therefore, of course, cash is going to be the most liquid. And what does liquid means? Liquid means that the asset or the current asset is going to be easily converted in cash. That's why cash is already cash. We don't need to convert it. And then we have the AR. The AR is accounts receivable and are all those sums of money that we have to keep track of because we didn't receive them yet from our customers. For example, if you run an ice cream shop and a customer comes in and he buys the ice cream but he doesn't pay yet, or he pays with a credit card, it means that you have to record the income but you cannot say that you got the cash yet. Therefore, until you don't get the cash, the sum of money that the customer owes you is going to be lumped in the AR. That's why we call it account receivable. The inventories instead are all those things that we have to store. For example, if you have a coffee shop and you buy 1,000 coffee bags, as you can imagine, you're going to use most of them in 1 month time, but it can be that in that month you're going to have 100 bags left. And those bags, the left ones, the remaining ones, will be your inventories. In other words, you're going to use them in the future to produce and to make coffees, but you have to keep track of them as well, and they will be considered as a current asset. Why? Because usually inventories are turned in cash in less than 1 year. That's usually the way it works. And then we have the prepaid expenses. The prepaid expenses are all those expenses that we pay in advance. For example, if you run a real estate investment operation and suddenly you buy a residential property, the first thing that you want to do before you rent the apartment is actually to set up the utility accounts for all your apartments. And the utility company is going to ask you to pay in advance the utilities, and that is going to be actually a prepaid expense. So this is how the current assets work, and those ones are the main current assets that you can find under any balance sheet. Then we have the non-current assets. The non-current assets are those ones who have a life longer than 1 year. And usually we can find under non-current assets plant and equipment, but it really depends by the company balance sheet. For example, if it is an high-tech company, you're going to find also other non-current assets such as licenses or patents. So you can find all these kind of things under your non-current assets. And usually the main difference between current assets and non-current assets is also that they are subjected to depreciation and amortization. But keep in mind that depreciation is going to be applied to all the tangible assets or those assets who have a physical life, such as plant and equipments. On the other side, all the other non-current assets such as licenses or patents, they will be subjected to amortization, so that's the main difference. If we go on the other side of our balance sheet now, we can find the liabilities and the equity. The liabilities are all those obligations that a company has, or all those debt, for example, that a company has to pay, or all the obligation that a company has to pay back in the next future or in 1, 2, 3 years. It depends by the kind of obligation that the company contracted. Now, the main current liability, also here we have current and long-term liabilities. The current ones are those ones who will be or will have a life of less than one accounting cycle or 1 year, and the long-term will have a life longer than 1 year or one accounting cycle. The main current liabilities will be the AP or accounts payable, short-term loans or accrued expenses. The AP or accounts payable are all those sums of money that we still have to pay, although we already got the materials that we bought. For example, if you again have a coffee shop and you bought those 100 bags of coffee, but this time you said to your supplier, I'm going to pay in 2 months' time. Well, since you have to pay for those money, but you're going to pay in 2 months, for 2 months, those sums of money will be actually reported on your AP until you don't pay them in cash. And then we have short-term loans. For example, if you go to the bank and you take a loan, this is a short-term loan. And usually those ones are the ones that have a life for 3, 6, 9 months, less than 1 year. That's the important thing. Otherwise, they're going to be classified as long-term loans, and therefore they will be classified under long-term liabilities. And then we have the accrued expenses. The accrued expenses are all those expenses that we actually have to pay, but we didn't pay yet in cash. For example, if you have to pay a bonus to your employees, but you just accrued it for a certain month, but you're going to pay it in 2 or 3 months, that's where you're going to keep track of all the money that you still have to pay to your employees or the bonuses under your accrued expenses. After the current liabilities, we have the so-called long-term liabilities, such as long-term loans, and that's one of the most common cases of long-term liabilities. And then we have the so-called equity. Equity is going to be money that you endow in your business, and this money is going to entitle you to be a shareholder. Therefore, you're going to get a percentage or all the profits of an organization. And keep in mind that part of the equity is going to be also the retained earnings. The retained earnings are all those profits that are actually not distributed to shareholders. Those are the main components of the balance sheet. We can move forward now.